Hi folks, welcome to this video on cash flow. Now, there's a few problems I'm going to try and get through here. And the first one is in your textbook, and it's labeled in your course, and it's related to tallware networks. And the data that we have in front of us shows us a comparative balance sheet from one year to the next, and it also gives us the income statement for the current year. So you'll remember that when we're doing a cash flow statement, we have to start with cash flow from operating activity. Next, we go to investing activities and then financing activities. So I'm just reinforcing the fact that there's an order to the cash flow statement. You'll also notice that the three-line title is very similar to the income statement. You have the name of the company and the first line. Instead of income statement, you have cash flow statement or statement of cash flow. And then for the year ended, just like you would have for an income statement, because you're reconciling the cash balance from the beginning to end, so it is for a period. And our period ends December 31st, 2014. So now, if we look at how we do the cash flow statement, we use the indirect method. Using the indirect method, that means when we calculate the cash flow from operating activities, we start with net income. Our question tells us that net income and the income statement is $93,800. So our task is to convert that $93,800 in income to the cash basis. So let's see how we can do that. What we're going to do first is we're going to look at any of the non-cash current assets whose balances have changed. And we can see we have two non-cash current assets. If we look at the comparative balance sheets, we see accounts receivable and we see inventory. So we can see that our inventory, that our accounts receivable increased. When accounts receivable increases, what that means is that our credit sales went up more than we collected on credit sales. And don't forget, since we're converting to the cash basis, net income is going to show on the accrual basis. It's going to show the sales revenue that you booked. It's not going to show any cash collected. We want to reflect cash collected, which is $5,600 less than what we booked on account. So that means that we're going to have to decrease our net income by $5,600 because net income includes sales revenue, which is greater than cash we collected. We want to reflect a lower amount, which is $5,600 less in cash collected than we booked in sales revenue. We also notice that our merchandise inventory, again, inventory is a current asset, we notice that it's actually gone up by $35,000. So when we look at that, how does that affect our cash flow statement calculation? Well, when our merchandise inventory goes up, that means that we bought more, or what we purchased cost us more than what we actually expensed to income in cost of goods sold. Because when we expense inventory, we debit cost of goods sold and credit inventory. But because inventory increased, that means that we must have bought more inventory than we expensed through cost of goods sold in the income statement. I want to reflect the higher cost of what I bought because it's the cost of what I bought that I will pay out in cash. So therefore, in order to reflect the cost of what I purchased, which is greater than what I expensed as cost of goods sold, I need to decrease net income by $35,000. Now you'll notice in your comparative balance sheet, if we look underneath merchandise inventory, we have equipment and accumulated depreciation. These are related to investing activities. So we'll hop down now to the liability section and we see two current liabilities, accounts payable and income taxes payable. So now we can see that our accounts payable has decreased. And if we do the calculation, as we've done down here, we see it's a decrease of $12,600. Because our accounts payable has gone down $12,600, what does that mean? Well, it means that we paid down more of our accounts payable than we actually racked up or increased accounts payable by. So when we talk about racking up accounts payable, it means that we must have recorded an expense when we bought the items we bought and credited accounts payable. All we're saying is that we decreased our cash more than we racked up as expense and income, right? And again, racking up expenses and income will increase your payables. So therefore, what do we need to do? We need to decrease our net income by the change in accounts payable, which was a $12,600 decrease, because we paid out more cash, which is why accounts payable decreased, than we actually racked up in accounts payable, which debits expenses. So we want to reflect a higher amount of cash going out, which means we need to decrease our net income by $93,800. We also notice that our income taxes payable have gone up by $1,400. That means that we recorded more income tax payable, so we increased income tax payable more than we debited it by paying out taxes. So we want to reflect the fact that we paid out, we want to look at what we've paid out in income taxes to settle our income tax payable, not what we racked up in taxes payable, which affects income tax expense, which is included as part of the $93,800. So therefore, to reflect the fact that our income taxes payable increased, what we need to do is we need to increase our net income by $1,400.